Every business eventually hits a threshold where future growth depends on the strategic deployment of massive, long-term funding. This is the mechanism of capital budgeting, the process where current liquid funds are committed to operations intended to generate returns over a multi-year horizon. These are monumental corporate maneuvers. Whether expanding production facilities or replacing obsolete equipment, these decisions dictate the physical reality of the company for years to come. These projects demand huge outlays of limited capital upfront, and they carry a high degree of risk, since future market conditions and technological shifts remain entirely uncertain. What makes this process so critical is its irreversibility. Once millions of dollars are sunk into specialized fixed assets, there is rarely a viable second-hand market to recover those costs. If the investment fails, the firm simply absorbs a heavy loss. Because an incorrect allocation permanently locks the firm into a sizable burden of fixed costs, like insurance, rent, and interest, the evaluation framework must be rigorous. Any error in these long-term commitments translates directly to a reduction in the firm's total market value. The dilemma for financial managers is figuring out how to objectively compare multi-million-dollar project proposals that have completely different lifespans and entirely different cash flow timings. Sometimes the firm evaluates independent projects. In this context, accepting one proposal doesn't eliminate the ability to accept others. As long as a project meets a minimum required return and the firm has the funds, it proceeds. But often, projects are mutually exclusive. This means proposals directly compete with each other. If a company needs a new temperature control system, choosing System A permanently removes System B from consideration. You can only pick one. To make that choice, managers rely on specific appraisal mathematics. Older, traditional techniques tend to prioritize immediate liquidity and simple accounting metrics to evaluate whether a project is worthwhile. To accurately evaluate a mutually exclusive project and find the maximum value creation, the firm must adopt modern techniques that strictly account for the time value of money. This chart compares two mutually exclusive investments. Project X generates heavy cash returns early, in years 1 through 3. Project Y returns the bulk of its cash in years 4 and 5. Both require an identical initial capital investment of 10 million rupees. We evaluate this first using the payback period method, measuring the exact years required to recover original capital. By accumulating cash inflows year by year, we track exactly when that 10 million rupee threshold is breached for each project. Project X hits the target, recovering the funds faster. It is the preferred choice. In corporate environments, this provides useful insight into liquidity, protecting against the risk of technological obsolescence by emphasizing the earliest possible recovery of initial investment. Yet, the payback period has a critical failure. By strictly counting the years to recovery, it ignores the massive cash flows Project Y generates after the payback threshold is crossed, and it ignores the time value of money entirely. This brings us to the second traditional framework, the accounting rate of return, or AAR. Unlike the payback period, AAR evaluates the entire expected life of the project. It calculates profitability by dividing the project's average profit after tax by the average investment required. The weakness of AAR is its reliance on financial statement accounting data, specifically net income, rather than actual spendable cash flows generated by the project. Because of this, it ignores the timing of those cash inflows. ARR treats a dollar earned in year 1 as having the exact same economic value as a dollar earned in year 5. To fix this timing flaw, the firm must adopt discounted cash flow techniques. This brings us to net present value, or NPV. The first component involves forecasting the future cash flows, represented as CT, across the specific lifespan of the project, T. Next, we apply the discount factor, R, representing the firm's required cost of capital. Finally, we subtract I, the initial sunk capital investment. Look at this timeline isolating Project Y's year 5 cash flow of 400,000 rupees. This demonstrates how discounting alters the value of money over time. Mechanically, that future cash is divided by the cost of capital. As we pull that cash flow backward to year 0, its present value shrinks in size. This gives us the NPV acceptance rule. Once you sum the present value of all inflows and subtract the initial investment, if the final number is positive, the project is acceptable. A positive NPV proves that cash inflows are being generated at a rate higher than the minimum return required by the firm. When choosing between mutually exclusive projects, the highest NPV represents the greatest surplus of value generated beyond the cost of initial funding. By selecting the project with the largest positive net value, the firm captures the most wealth possible from its available resources. There is another popular discounted cash flow alternative, the internal rate of return, or IRR. Executives often use this method because it presents profitability in a percentage format. Mathematically, IRR is the specific discount rate at which a project's net present value equals exactly zero. The acceptance rule here is simple. A project is approved only if its internal rate of return exceeds the firm's cost of capital. But here is the conflict. When evaluating mutually exclusive proposals with different cash flow timings, NPV and IRR will frequently provide contradictory rankings. The discrepancy comes down to what happens to intermediate cash flows. NPV realistically assumes they are reinvested at the firm's standard cost of capital. IRR assumes those intermediate cash flows are reinvested at the project's own internal rate. For highly profitable projects, this creates an unrealistic reinvestment assumption that skews the math and can result in multiple conflicting rates for a single project. Because it utilizes a grounded reinvestment rate and avoids multiple answers, NPV remains the definitive framework for capital allocation. In the real world, firms face a constraint known as capital rationing. What happens if a company has multiple positive NPV projects available, but faces an absolute limit on external funding? It cannot afford to take on every profitable proposal. To solve this, financial managers use the profitability index. This is the mathematical solution for evaluating projects under a strict capital ceiling. Rather than measuring absolute wealth creation, the profitability index measures efficiency. It calculates the present value created per dollar invested. To maximize wealth under a fixed budget, a firm ranks all available projects in descending order by their profitability index and funds them until the capital runs out. Successful capital budgeting requires moving past simple accounting and short-term liquidity metrics. The modern toolkit relies on a rigorous estimation of cash flows, strict application of the firm's cost of capital via net present value, and strategic portfolio packing using the profitability index. These decisions are irreversible long-term commitments. They establish the fixed costs and dictate the competitive capacity of the firm for years. Applying this mathematical framework ensures that every million-dollar commitment is backed by the reality of discounted cash flows. It is the process for selecting the investments that will define the firm's competitive capacity and total market value over the next decade.